The markets are dark. The ticker frozen at $79.25. Holiday silence across the trading floors. But inside the boardrooms of Lower Manhattan, inside the conference rooms of the Federal Reserve, panic is spreading. Emergency risk management sessions are unfolding this weekend at the highest levels of the global financial architecture. Silver moved 10% in one day. That is not a price event. That is a solvency detonation. When a core commodity moves that violently, the damage is structural. Risk models inside the banks shatter. Margin frameworks at the hedge funds collapse. And the clearinghouse, the central nervous system that guarantees every trade, begins to seize. If a major institution cannot meet its obligations Monday morning because it shorted silver, the clearinghouse absorbs the loss. If the clearinghouse cannot absorb the loss, the system locks. This is where we are. This emergency transmission exposes what is happening behind those closed doors right now. The playbook they deploy when cornered. The rule changes being drafted for Monday. The margin expansions. The position caps. The trading freezes. These meetings are not coordination. They are containment operations. The banks are terrified of the Sunday night open because they know if silver gaps to $85, this ends badly for them. This is the weekend the system blinked. To grasp why these meetings are mandatory, you must understand leverage mathematics. Banks do not trade silver with capital. They trade with borrowed money at ratios of 20 to 1, sometimes 50 to 1. In calm markets, this generates frictionless profit. When the market moves 10% against the position, leverage becomes a kill mechanism. The math is brutal. Leverage 20 to 1, a 5% adverse move erases 100% of equity. Total wipeout. Silver moved 10%. Any entity leveraged 10 to 1 or higher on the short side is now mathematically insolvent. Equity destroyed. They owe money that does not exist in their account. Normally, the bank issues a margin call and forces payment. But what if the counterparty is systemically important? A sovereign wealth vehicle, an industrial hedger, another bank? You cannot liquidate them without triggering market collapse. So you convene. You call regulators. You call the Fed. You say the words no one wants to hear. If this market opens Monday, entity X defaults. We need emergency protocol. Bear Stearns, 1998. Long-Term Capital Management, 1998. The Hunt Brothers, 1980. All weekend meetings. All rule changes engineered to avoid paying the bill. Right now, they are modeling containment scenarios because if silver opens at $85 tonight, insolvency spreads from the client into the bank itself. We are staring at contagion, and silver is the infection vector. Clearinghouse exposure is the nightmare layer. The CME Group operates a default fund, a collective insurance pool funded by member banks. If one member fails, the fund covers it. But the fund is finite. With silver at $79, the notional value of aggregate short exposure is in the billions. If price gaps again, losses could drain the entire default fund. This is the apocalypse scenario. If the fund exhausts, the exchange itself is at risk. Trader confidence evaporates. Liquidity vanishes. To prevent this, the exchange has emergency authority. They can halt all trading. They can raise margins to 100%. They can force liquidation-only mode. This weekend, the legal teams are hunting for the closet that allows them to disable the buy button. They executed this with nickel. They executed this with GameStop. Do not assume silver is exempt. They will do whatever it takes to preserve the structure, even if it incinerates the credibility of the market forever. Collateral is rupturing simultaneously. Banks pledge government bonds as collateral for their positions, but bonds are wobbling. Debt ceiling fight looming. Inflation accelerating. Collateral value falling precisely as liability surges. Double squeeze. They are being crushed on their shorts and crushed on their collateral backing. This forces asset liquidation to raise emergency cash. Monday could see stock dumps. Crypto liquidations. not because those assets failed, but because banks need liquid capital to plug the black hole in precious metals. A silver squeeze becomes a macro liquidity event. It vacuums liquidity out of every other market to fill the void. This weekend meeting is not about silver. It is about preventing systemic liquidity failure. They are attempting to ring-fence the detonation. But here is their trap. They can manipulate the paper market. They can rewrite COMEX rules. They cannot control physical. They cannot control Shanghai. They cannot control premiums at coin dealers. If they freeze the paper market or artificially cap price, the physical market simply decouples. Shanghai trades at $100. New York stuck at $79. Every ounce in the West flows east to capture arbitrage. Their solution accelerates the problem. It drains Western vaults faster. They are trapped. Psychological warfare is incoming. When these emergency sessions conclude, narratives will leak to media. Expect Sunday afternoon headlines. Regulators monitoring commodity volatility. Banks confirm liquidity remains adequate. Experts caution silver bubble forming. They need to engineer fear. They need retail to sell on the open so banks can cover. They need your liquidity to patch their mistakes. But this time the narrative control is failing. The public stopped listening to bank spokesmen. They are watching price. $79 on silver. Gold at $4,500. The confidence game is breaking. When confidence breaks, meetings cannot repair it. Only price settles it. As we approach the Sunday open, understand the game is rigged, but the rigging is now backfiring. The leverage they deployed to suppress price is now the mechanism driving it vertical. The rules they authored to protect themselves are now the cage trapping them. This is system failure in real time. The outcome is price discovery. The market is searching for the level where banks stop hemorrhaging. That number is far above $79. The emergency meeting is the signal. We have reached the pain threshold. Now we watch their response. Fight or capitulation. The tools they can deploy Monday morning are limited and costly. Margin hikes are the standard first move. They tried last week, raising margins 50%. It failed. They can escalate to 100% margin, meaning no borrowed capital allowed. Cash only. This kills leveraged speculators. Hedge funds using margin are forced to sell when they cannot post full collateral. This creates artificial selling pressure. In 1980, margin hikes bankrupted the Hunts. But today is different. The buyers are not speculators on margin. Samsung is not borrowing. The People's Bank of China is not borrowing. They are cash purchasers. Margin hikes hurt small traders, but do nothing to industrial whales. The whale has infinite cash relative to position size. In fact, whales prefer margin hikes because it shakes out weak retail, giving them cheaper entry. Position limits are the next weapon. The exchange declares no entity may hold more than 3,000 contracts. If you hold 5,000, you must liquidate 2,000 by Monday noon. Direct intervention forcing whales to shrink. But capital is fluid. If COMEX limits positions, the whales migrate to OTC markets. They move to London. They move to Shanghai. You cannot stop a global metal rush by erecting a barrier in New York. The nuclear option is liquidation-only mode. The exchange permits selling, but disables all buy orders. Demand is banned from the platform. Price guaranteed to fall because buying is prohibited. If they pull this trigger, it is the end of COMEX credibility forever. Investors will abandon U.S. futures and never return. They will migrate to exchanges that allow price discovery. Shanghai is operational. Dubai is operational. If New York closes the buy door, they hand global market control to China. The geopolitical cost is unbearable. They may threaten liquidation only, but executing it is suicide for dollar hegemony. The banks are boxed. Every tool has a cost. Every intervention accelerates the exodus from dollar-denominated markets. Every rule change is proof the system is broken. They are trying to extinguish fire with explosives. This weekend coordination is an attempt to engineer a soft landing. Let price rise, but slowly. Manage the ascent to avoid mass insolvency. But markets in vertical ascent are not manageable. Crowd psychology has taken control. The crowd smells blood. The Monday morning gap is critical. Because of uncertainty from these meetings, liquidity Sunday night will be non-existent. No trader wants exposure before new rules are announced. The order book will be empty. If any buyer arrives, price will teleport. Silver could open at $85 simply because banks are too terrified to sell. Fear cuts both ways. Banks scared to be short. Traders scared to be short. Path of least resistance is vertical because no one wants to stand in front of the train. This fear gap is the signal. If we open significantly higher, the meeting failed. They found no solution. Panic is uncontrolled. If we gap down, if silver opens at $75, they found a way to strike the market. Maybe coordinated central bank dumping. Maybe emergency rule change. If this happens, do not panic. It is opportunity, the system giving you one final window to acquire physical metal at suppressed price before physical reality overwhelms the paper illusion. You must learn to read gap language. Up means loss of control. Down means temporary intervention. Both roads lead higher eventually. The path differs. Physical dealers are watching these meetings too. They know if rules change, their hedges may become worthless. So premiums stay elevated. They are protecting inventory. Do not expect dealer freezes to end Monday. If volatility continues, more dealers will shut down operations. The separation between spot and physical will widen. We may see spot at $80 and physical at $110. That spread is the risk premium of system failure. As an investor, focus on physical price. That is your net worth. Paper price is a number on a screen used by banks to settle wagers. Physical price is what you can obtain for your metal in the real world. The real world is bidding higher. The lights are burning. Coffee flowing. Lawyers arguing. The weekend meeting drags into the night. They are searching for an exit. There is no exit. They sold more silver than exists on earth. Now the owners want delivery. Oldest story in finance. A short squeeze on a finite substance. You cannot print silver. You cannot legislate it into existence. You dig it or buy it. Right now, they can do neither. Monday is coming. Judgment is coming. Contagion risk extends beyond silver contracts into the plumbing of the entire financial structure. Silver does not exist in isolation. It ties directly into the repo market, the pawn shop of Wall Street, where banks lend cash overnight using treasury collateral. When massive volatility hits a core commodity, it shocks the risk algorithms governing repo. If a bank is bleeding cash to cover silver margin, they stop lending in repo. They hoard liquidity. This causes overnight rates to spike. Liquidity freeze begins. September 2019, the repo market broke. The Fed had to inject billions instantly. Signs indicate the silver spike is causing similar seizure in the plumbing. Banks look at each other with suspicion. Are you the one short silver? Are you insolvent? When trust evaporates, credit evaporates. When credit evaporates, equity markets crash. This is why the Federal Reserve is in these weekend meetings. They do not care about silver price. They care about J.P. Morgan stability. If J.P. Morgan cannot access liquidity because balance sheet impairment, the Fed must intervene. Fed put activated. But here is the doom loop. If the Fed steps in to save banks, they must print money. If they print money, silver rises. To save the system from high silver prices, they must execute the exact action that causes high silver prices. They are trapped in their own mechanism. While bankers sweat in New York, mining CEOs are celebrating. For a decade, miners were abused by paper markets. They extracted the rock. Bankers set the price. Razor-thin margins while banks made billions trading paper. Today, the power dynamic inverted. Miners possess the one asset banks desperately need: physical inventory, and they are withholding. Reports indicate strategic stockpiling. Mining companies choosing to vault production at mine sites rather than ship to refiners at current price. Why sell at $79 today when you can sell at $100 next week? They are acting as central banks, managing reserves. This creates supply air gap. Banks counting on new mine supply to flow into COMEX and relieve pressure. Supply is not arriving. It sits in a vault in Mexico. This forces banks to bid even higher. They must bribe miners to release metal. Miners demand a king's ransom. Nationalization risk escalates. It is Sunday. Governments in Latin America are watching this price action. Mexico produces 25% of global silver. If silver hits $100, will the Mexican government allow foreign companies to capture all profit? No. Windfall taxes incoming. Export restrictions possible. Domestic strategic reserve mandates likely. If Mexico announces export restrictions Monday morning, silver price doubles instantly. Banks know this exposure. That is why panic is setting in this weekend. They are short a strategic asset located in foreign jurisdictions they cannot control. Ultimate unhedgeable risk. Shadow bank failure rumors are circulating. Every crisis has a casualty no one anticipated. 2008 was Lehman. This crisis will likely be a shadow bank or massive commodity trading advisor. Unregulated entities using extreme leverage. No safety nets like the major banks. Rumors indicate a major commodity fund in London is destroyed. They were short silver, long bonds. Both trades went against them simultaneously. If this fund liquidates Monday, it triggers massive market buy orders for silver. Forced buying. Does not care about technical resistance. Does not care about overbought indicators. Just buys until position closed. This is melt-up fuel, not organic demand. Liquidation mechanics. Liquidation creates price vacuum. Sucks price higher faster than any fundamental news. Because it is happening during holidays, the vacuum is stronger. Tech sector involvement is accelerating. Samsung, Microsoft, their procurement teams are working overtime this weekend, securing off-market deals, calling miners directly. We will purchase your entire 2026 production. Name your price. If a miner signs with Microsoft, that silver never reaches public markets. It disappears. This shrinks the float further. Visible COMEX inventory shrinking because invisible inventory growing in corporate stockpiles. Privatization of supply. Market bifurcating. Public price volatile and broken. Private price much higher. Banks stuck in public market trying to cover shorts in a pool being drained by private transactions. If you hold cash and want exposure, you are nervous. You want entry, but not at the top. You hope for pullback. In liquidity crisis, pullbacks are shallow and violent. If silver gaps to $85 Monday, do not chase immediately. Wait for first hour flush. After massive gap up, profit takers usually step in first hour. Price dips. Tests breakout. That is entry. But warning, in runaway markets, sometimes the dip never materializes. Sometimes price hits limit up and stays locked. If that happens, you missed it. This is why core position is mandatory. Position you never trade. Insurance against melt-up. Gold correlation provides mathematical floor. Gold trading at $4,534. Stable. Strong. Acting as anchor. As long as gold holds these levels, silver cannot crash. If silver crashed to $50, gold to silver ratio would explode to 90. Arbitrage algorithms would instantly sell gold, buy silver to close spread. Gold provides floor under silver. Banks cannot smash silver without smashing gold. Smashing gold is harder because central banks are buyers. You cannot bully a central bank. Banks fighting war on two fronts, losing both. Media blackout continues. Why is this not front page Wall Street Journal? because they cannot afford panic. If public realizes banks are insolvent, that currency is breaking, we get bank runs on grocery stores. Hyperinflation psychology ignites. So media ignores it. They discuss tech earnings, political scandals, distraction of the herd. But the herd is waking. Google Trends does not lie. Search volume for silver price is vertical. People bypassing media gatekeepers, going straight to source. This grassroots awakening is powerful. Next wave of buying will be physical, not paper contracts, coins and bars. That is the one thing banks cannot print. They can print futures contracts. They cannot print silver eagles. As we wait for Sunday open, tension is maximum. Meetings ongoing. They search for bailout, for rule change. Running out of time. Sun rising in Asia. Markets about to open. Verdict incoming. When an asset breaks all-time highs, it enters blue sky territory. Technical term. No historical data. No resistance lines from years past. No bag holders waiting to sell. Only open space. In blue sky, traditional analysis fails. You cannot look left on the chart for guidance. Algorithms use Fibonacci extensions to navigate. Mathematical ratios derived from nature predicting human behavior in absence of data. Currently at $79.25. Measuring from breakout at $50. First major Fibonacci extension target is 1.272 level. That target sits roughly at $85. First magnetic level. When market opens Sunday night, algorithms programmed to chase price to $85 acts like tractor beam. If we break $85, next target is golden ratio, 1.618 extension, target near $96. Just above that, psychological fortress of $100. Roadmap for next leg clear, 85, 96, 100. Not random guesses. Mathematical waypoints high-frequency bots use to navigate unknown. They will buy until hitting these levels. Pause. Reload. But human element in blue sky as well. Euphoria. When price makes new all-time high every day, creates feedback loop of attention. Media cannot ignore. Public cannot ignore. Creates viral chart. People share on social media. Talk at work. Did you see silver? This viral energy powers move through Fibonacci levels. Provides fresh capital to sustain vertical ascent. Transition from technical breakout to social breakout. Social breakouts are messy, violent, incredibly profitable. Retail stampede is waking. Retail public has trillions in savings accounts earning negative real rates. Trillions in checking. Historically, public is last to enter bull market. When they enter, tsunami of cash dwarfs professional money. Right now, public is waking but faces accessibility problem. 1980, you walked into coin shop, bought bag of silver. 2025, coin shops empty. Online dealers crashed or sold out. ETFs trading at premiums. Where does retail money go? Mining stocks. Path of least resistance for average investor. They open brokerage app. Search silver. Buy first mining stock visible. This is why mining sector goes parabolic next week. Only place retail capital can fit. If you own mini stocks, prepare. About to be flooded with liquidity from millions of retail investors desperate for exposure, unable to buy physical. Penny stocks become dollar stocks. Dollar stocks become $10 stocks. Trickle down of the squeeze. Shortage in metal forces money into equities. Psychological barrier of $100. 3 digits. Sounds impossible to people remembering $5 silver, but in hyperinflationary environment, zeros add quickly. Bitcoin went $100 to $1,000 in 1 month. When paradigm shifts, denomination changes. $100 is where unit bias shifts. People stop buying ounces, start buying grams. Dealers will price silver in grams to appear cheaper. Buy gram of silver for $3 sounds better than buy ounce for $100. This marketing shift brings smallest investors, people with $50 to spare, democratizes squeeze. Millions of small cash buyers harder to stop than one big buyer. Cannot margin call million people who paid cash for gram. Industrial substitution argument fails. Banks hoping at $80 industry stops buying. Demand destruction. Falls. For missile guidance systems, silver price irrelevant. For solar panels, small fraction of cost. But flip side, panic inventory building. If CEO sees silver going to $100, does not stop buying. Buys more than needed. Buys 2 years inventory today to lock price. Thinks, if I buy at $79, I am genius when it hits $150. Higher prices increase industrial demand short term. Triggers hoarding reflex in corporate suite. Removes more metal from market. Accelerates shortage. Banks using wrong textbook. Back to emergency meeting. What is nuclear option for regulators? If they cannot stop price, if clearinghouse failing, they might attempt demonetization. Laws prohibiting silver as collateral. Taxes on silver profits at 80%. Ban private bullion ownership. Endgame risks. Not there yet, but must be aware. When government loses currency control, attacks alternatives. Silver is alternative. Privacy becomes critical. If they ban or tax to death, you want silver invisible. Off books. Black market premium we discussed is price of invisibility. Government attack is bullish for physical holder, even if frightening. Currency swap lines burning. Federal Reserve has swapped lines with other central banks to flood world with dollars, keep system liquid. This weekend, swap lines likely burning hot. Fed sending dollars to Europe, Japan to help cover their banks' commodity losses. Creates flood of new dollars in system. Global liquidity rising. What floats on sea of liquidity? Hard assets. The mechanism they use to save banks ensures silver goes higher. Trapping themselves. Sacrificing currency value to save market structure. Definition of crack up boom. Market rises because currency is dying. Monday morning open. Volume profile critical. Usually early Asian trading is thin. This time expect massive volume from Bell. Why? Arbitrageurs waiting. Watching Shanghai price. Watching New York price. Ready to pounce. If we see massive volume on open, confirms move is real. Low volume with price spike might be trap. Low volume spikes reverse easily. High volume spikes are concrete. Watch volume bars. If millions of ounces trade first hour, banks capitulating. If quiet, planning sneak attack later. Watch oil. Oil is master commodity. If oil spikes Monday due geopolitical tensions, drags silver with it. Higher oil means higher mining costs. Higher inflation expectations. Silver and oil are kissing cousins, often move together during crisis. If oil breaks $80 or $90, silver breaks $80 instantly. Bond yields. If 10-year Treasury yield spikes, bond market crashing. Usually higher yields hurt silver. In debt crisis, higher yields help silver because government losing control. Yields spike and silver rise together signals sovereign debt crisis. Market rejecting government paper. 1970s playbook. Happening again now. Checklist for Sunday night. Watch gap. Opens above $80. Watch volume. Heavy or light. Watch gold. Holding $4,500. Watch oil. Rising. Watch yields. Spiking. If all 5 lights green, no ceiling. $85, then $90. Emergency meeting failed. Free market won. We have arrived. We spent this transmission dissecting emergency meetings, clearing house failures, industrial panic consuming silver market. Charts. Geopolitics. Math. Now your portfolio. In less than 24 hours, markets reopen. Algorithms reactivate. capital flows. You face most volatile session of your life. Decisions you make or fail to make in first trading hour could determine financial future for next decade. First rule Monday open. Do not sell. When you see price gap up, when account balance jumps 10 or 20% in 1 minute, temptation to cash out will be overwhelming. You will think, sell now, buy back on dip. This is the trap. In liquidation event, which this is, there may be no dip. If banks forced to cover, they buy every contract offered. Sell position at $82, might never get it back. Watch price hit 85, 90, 100 while sitting in cash praying for crash that never comes. Trading scarce asset for abundant asset. In crisis, hold scarcity. Unless desperate need for immediate cash, do not sell. Let market run. Let shorts suffer. Let price discover true level. Your patience is your profit. Risk management. If you hold physical silver in your possession, you are safe. If you hold silver in vaulting service, ETF, or brokerage account, audit counterparty immediately. Read terms of service. Find force majeure clause. Find cash settlement clause. If exchange halts trading, does custodian have right to liquidate your position at last traded price? If yes, you are at risk. This weekend, consider moving assets out of banking system into private non-bank storage. Own ETF. Consider selling, buying physical or mining stocks. Mining stocks have equity risk, but not delivery risk of paper contract. You own share of company that owns hole in ground. Hole cannot declare force majeure. Silver is there. We are entering phase where possession is 9/10 of law. If you cannot touch it, might not own it when music stops. Nuclear scenario. What if losses so massive COMEX stays closed Monday, or opens, hits limit up, announces indefinite suspension to maintain orderly markets? Happened with nickel. Happened with Hunts. Real possibility. If exchange closes, spot freezes. Might stay $79.25 for week. Street price detaches. Frozen market, black market takes over. Dealers trade base Shanghai price or pure supply demand. Spot at $79. Eagles trading at $120. If this happens, do not panic. Closed exchange is ultimate validation of thesis. Paper manipulation failed completely. Price about to re-rate massively higher once market reopens. Do not sell physical for frozen spot price. Ignore screen. Wait for dust to settle. Real value of silver not determined by broken computer in New York. Determined by physics of scarcity. Opportunity. If you miss move in metal or want to add, where do you go? Miners. If metal gaps up, mining stocks open much higher. High beta. Silver up 10%, miners up 20%. Specific sector to watch. Developers. Companies that found silver but have not built mine yet. Bear market. These get crushed. Bull market. Shortage squeeze. These become takeover targets. Major mining companies running out reserves. Have cash from high silver price. Need to buy ounces in ground to survive. Wave of mergers and acquisitions incoming. When small miner gets bought, premium usually 40 to 50% overnight. Lottery ticket phase of bull market. If you have risk appetite, look at high-grade developers in safe jurisdictions. Next, domino. Mental tool for volatility. Stop pricing silver in dollars. Dollar moving down. Silver moving up. Chart measuring collision of two moving objects. Instead, price silver in assets. How many ounces to buy median home? 1980, roughly 800 ounces. Today at $79, roughly 5,000 ounces. Not there yet. Long way to reach 1980 purchasing power. How many ounces to buy Dow Jones? Need ratio collapse. By focusing on real purchasing power, detach emotions from dollar figure. Realize $79 is mile marker on highway, not destination. Destination is financial freedom. Financial freedom costs more than $79. Narrative will turn nasty. As price rises, politicians get involved. Call silver investors hoarders, speculators, economic terrorists. Say we are holding green transition hostage. Try to shame you into selling. This is propaganda. You are not terrorist. You are prudent saver. Recognized inflation before they admitted it. Recognized shortage before they fixed it. Being rewarded for foresight. Do not let them guilt you out of position. Government created mess by printing money, regulating minds out of existence. Market fixing mess by raising price. You are beneficiary of correction. Stand your ground. Checklist for open. 1. Check Shanghai price. Is it leading? 2. Check Globex open. Gap up. 3. Check news. Reports of bank failures. 4. Check dealers. Are they selling? If answer to all is yes, vertical acceleration. Best strategy is inactivity. Sit on hands. Let market run. Do not scalp dollars. Risk losing seat on rocket. If market gaps down, rug pull scenario, check volume. Volume light, it is trap. Buy dip. Volume heavy and news breaks Fed intervening, reassess. Right now, probability of crash low, probability of melt up high. Living through history. Generations from now, financial historians will study silver squeeze of 2025. Write books about weekend banks failed. Analyze charts we are looking at right now. You are not just watching. You are participating. Part of smart money that saw cracks in dam before it broke. This is rare privilege. Most people live entire lives without being on right side of massive wealth transfer. You are here. You are ready. Do not squander by being impatient. Do not squander by being fearful. Math is inevitable. Debt unpayable. Silver unobtainable. Price has to rise. Rising fast. Verdict. Emergency meeting was weakness, not strength. Banks panicked because powerless. Physical market wrestled steering wheel from paper market. Monday morning will be chaotic. Loud. Scary. For silver holder, profitable. $79.25 is floor of new paradigm. $80 is door. $100 is target. Get rest. Check security. Prepare for open. Greatest show on earth about to begin.